Today we are going to tackle the 4 C's of qualifying for a home. The 4 C's that lenders will evaluate in determining your ability to qualify for a home are loan credit, capacity, capital, and collateral. In this video, I will give you the guidance that you need to move forward with your purchase decision. Stick around until the end and I will provide a list of required paperwork to start the purchasing process. Sometimes it is even harder if you are both buying and selling. This adds a whole nother level to the whole process. It's important to remember that buying a home is a big decision and it's okay to feel scared or overwhelmed. The best decisions in life include some risk. If you reflect on your life so far, the best things in life have come from overcoming your fears and taking some risks. Think of relationships. What if you never took the risk of dating that special someone? What if you allowed your fears of failure or rejection to stop you in your tracks? What if you never had children? What if you never got your first dog? I believe that homes and people match just like a love connection. Homes provide so much joy, comfort, and peace. Homes play a huge part in the lifestyle that you live and the legacy that you will leave. There is a saying that knowledge is power. So let's get educated so that you can increase your power. Together, we can build your confidence to fulfill your dreams of homeownership. In other videos, I address the biggest fears of both buying and selling process and how to overcome them. Today, we are going to stay focused on the financial process of purchasing a home. The best way to overcome your fears is to face them head on. When you do, you will wonder what took you so long. So often, what we fear is not even reality. It takes stepping into our fears to overcome them. Action is required to move forward. I know that knowledge gives us courage to act. If you want to make a move, where do you start? Everyone is different. Everyone has their own needs and wants. It's important to me to understand where you are so that I can best guide you to your homeownership goals. There are many paths to get you there, and it's helpful to take any shortcuts we can to make the process as enjoyable as possible. So many of us try to go it alone and take wrong turns that can stop us in our tracks. The path to homeownership is filled with potential obstacles. I will help you overcome them with confidence. For personal guidance, you will want to schedule a private Zoom meeting with me. This way I can listen to and understand your personal wants and needs. Together, we can create a plan of success to help you achieve your goals. In the simplest terms, here are the main focuses in qualifying for a loan. Meaning, this is what the bank will evaluate to determine your qualification terms and the amount available to you to purchase your new home. Again, an easy way to remember is the 4 C's. The lender will evaluate these 4 components or risk factors. They are your credit, your capacity, your capital, and your collateral. Now, let's break them down. Component number 1 is credit. Your credit score helps the lender determine your ability or inability to repay the mortgage. They see it as a way to determine their risk in providing you with a mortgage. By looking at past behaviors, they are trying to predict future behaviors. Most lenders will start with a minimum of 620 credit score. A credit score of 580 can still be used to qualify for a home, although this will limit your options of loan types. The terms of your loan will be determined by the risk factors for the lender. A lower credit score will be less desirable for some loan types. A low credit score due to a lack of credit history or an unsatisfactory record of debt repayment can be a major setback, especially when hoping to qualify for a mortgage. In either scenario, there are a range of options for restoring credit health while staying on track for your home ownership. So many of us don't understand how to manage credit scores. I am going to give you my best hints and tricks. Remember, what they are looking for is your ability to manage debt. This means that if you do not use any credit, you will have a low credit score. I know, Dave Ramsey teaches us to avoid debt and use cash to help us to stay on track with our financial goals. Although this is great advice, it will not help you when you want to purchase your home. The lender needs to see at least 2 lines of credit. For example, a credit card and a car payment. If you are making monthly payments on a line of credit, it shows them that you are responsible and ready for a mortgage. Obviously, you will need to avoid late payments or overextending your credit. If you have a credit card with a limit of $1,000 You will want your balance at the end of each statement to be less than 400, or better yet, less than 300. This gives them the idea that you can manage credit well. If you have a line of credit of 1,000 and you owe 800 or 900, this will actually pull down your credit. Now, what if you are so good at following Dave Ramsey that you don't have any credit lines? Since there is no data on your spending habits reflected in your credit report, you will have a low credit score. My lender always suggests starting with your own bank. This is an easy way to keep track of, and typically you can manage your credit card and bank account in the same place. If you have never used credit before, your bank is the most likely to approve you and help you get started. A good idea to help you stay on track is to put your gas on your new card. When your payment comes due, be sure to leave a little carryover balance, even if it's a small amount. Like magic, your credit score will start climbing. A little trick that gives you a nice boost is to be added as a user to your parents' credit card account that already has an established long history of good reporting. Some lenders can add your cell phone payment or even your rent payment, utilities to your credit report. These are just a few options you might have in building credit that will increase your credit score. I know it seems backwards that the banks wants to see you getting into debt. That is not the case. They just want to see that you can manage your debt. So I am not suggesting that you run out and buy a new car or that you go on a spending spree. Simply start with something manageable and prove that you can borrow money and pay it back on time. You will need to be very careful with your spending habits during the purchasing process. I have had a few sad situations because my clients couldn't remember some of the deal breakers during the purchasing process. Here are the biggest warnings. Once you are pre-approved for a loan and in the process of securing your home, you will want to refrain from making any large purchases, such as a new car or putting new appliances or furniture on a credit card. The lender will do a final credit pull just before you sign on the dotted line and receive keys. I had a client who was days away from signing. His car broke down and he decided it was better to just buy a new car. He went to the dealership and they convinced him that if he purchased his new car that day, it wouldn't show up on his credit and it wouldn't affect his credit. They lied. When the lender did the final credit pull, his debt to income ratios were too high and it disqualified him for purchasing the home. He was unable to move forward. It was so sad. This is why the lender and I advise you to hold off on any large purchases. Remember, if you overextend your credit limit on a credit card, which means using more than 40% of your credit available, it drops your credit score. This is why you will need to wait to buy your appliances and furniture. Okay, so once you have keys, you are free to make the financial decisions that you feel are necessary. But during the purchasing process, everything needs to remain the same as when you were qualified. Component number 2 is capacity. The lender will be looking at your debt to income ratio to determine your capacity to afford a mortgage payment. To calculate your debt to income, you add up all your monthly debt payments and divide them by your gross monthly income. As a general guideline, 43% is the highest debt to income ratio a borrower can have and still get qualified for a mortgage. Ideally, lenders prefer the debt to income ratio to be lower than 36%, with no more than 28 to 35% of that debt going towards servicing a mortgage. Lenders look at your income, your employment history, your savings, monthly debt payments, and other financial obligations to make sure that you have the means to comfortably take on a new mortgage. One of the ways lender verifies your income is by reviewing several years of your federal income taxes and your W-2s, along with current pay stubs. They evaluate your income based on the source and type of income, meaning is it salaried, is it commission, or are you self-employed? They also take into account how long you've been receiving the income and whether it is considered stable. They will want to know how long that income is expected to continue into the future as well. The lender will request an employment verification that will help provide answers to those questions. Lenders will also look at your reoccurring monthly debt or liabilities, such as your car payment, your student loan, your credit card payments, personal loans, child support, alimony, or any other debts that you may be obligated to pay. A word of caution: once you are approved, you will not want to make any changes to your job. I had a client who was offered a better job while he was in the middle of purchasing his home. He forgot this rule and he made a switch. Unfortunately, it changed our ability to purchase. I know, it doesn't make any sense. If he's making higher income, why wouldn't he qualify? It was a matter of the lender's ability to verify the income. They had to start over with a minimum of 30 days pay stubs. They also had to obtain new employment verification to assure that the new job was secure and permanent. They needed to confirm that the new income was based on a W-2 and did not rely on bonuses. You have to lock in and stay the course once you are pre-approved. My best advice is before you make any decisions, big or small, ask the lender before you move forward when you are in the course of the loan approval process. To increase your purchasing power, you might need to pay down some debt. This will take some discipline and budgeting, but it's very doable. Most of my clients, when selling a home and purchasing another, choose to pay off their debts before investing the rest of their equity into the new home. You could also consider consolidating your debt into a single payment. You can also try and find a lower interest rate for your debt. Increasing your income will always improve your situation. When was the last time you received a raise? It doesn't hurt to ask. What about a gift? Is there someone in your life who could help you with a down payment? I have some clients who caught the vision of home ownership very young. They are recently out of high school and were high school sweethearts. He did trade school and was doing great in his career. His parents were so excited to be able to support them in their dream of buying their first home and gifted them some funds to help them with their down payment. They had qualified on their own, but this allowed them to set aside some money for repairs. When we talked about their wants and needs, they had expressed their desire to purchase a single family home. I helped them realize that this would mean purchasing something older and smaller than if they actually chose a townhome or a condo. Their biggest motivation was their dog. They wanted a yard for him so that he could run and play. My client also loved working on cars, and a garage would be a huge plus. They weren't afraid of buying a home that needed some upgrading. They were willing to make the sacrifices of buying a home that was outdated or needed some cosmetic repairs. We found the perfect match. The seller was a car guy too. The detached garage was perfect for working on cars, and the extra driveway space allowed my client to park several cars at a time. The yard was fully fenced and ready for a big dog. The interior of the home needed some updating, but they were excited to take on a few new projects. They knew it would take some time, but they were willing to make the sacrifices to achieve their goals. I'm Janet Marroquin with Coldwell Banker, and my Google page is Janet Sells Homes in Utah. Component number 3 is capital. Different loan types require varying amounts of down payment and terms. If you do not have a lot of capital, don't freak out. There are programs available that have very low requirements. In fact, there are even some programs that offer a 0 down payment plan. I have another video where I will go into details about the different loan types, but for today, let's stay on track. Lenders love to see that you have readily available money and savings plus investments. This may include properties and other assets that could be accessed fairly quickly for cash as well. Having money saved in investments that can be easily converted to cash, known as cash reserves, proves that you can manage your finances and have funds in addition to your income to save for a mortgage. Cash reserves might include savings, money market funds, other investments that can be converted to cash, such as individual retirement accounts, known as IRAs, certificates of deposit, known as CDs, stocks and bonds, or 401k accounts. Along with cash reserves, other acceptable sources of capital might include gifts from family members, down payments or closing cost assistance programs, grants, or matching fund programs. Sweat equity could work as well. This last one is extremely rare, but I have seen it done. When you apply for a mortgage, the lender will need to verify the source of any large deposits into your bank account to ensure that they're coming from an allowable source. That is, that you obtained the money legally and that it was not loaned to you. I had a client who, in preparing to purchase a home, sold a car. We had to make sure that he had the proper bill of sale. He also couldn't receive cash or it would complicate the process since cash cannot be properly documented. Another common example is gift funds. When receiving gift funds, the lender will need to see a bank statement from the person providing the gift to show that the money left their account, along with a bank statement of your own showing that your account received the funds. The person gifting the funds will also sign a letter stating the amount of the gift funds. I have a client who had a side hustle. She was constantly depositing small amounts of cash. The lender lost their mind. It was impossible for them to verify where these funds were coming from. We had to convince them to ignore the small deposits. She did not need that income to help her qualify for the loan. Neither was she using that money for her down payment. She had enough money in her savings to cover the amount needed. Once we realized the problem, she held onto the cash and the small checks until we finished the home purchasing process before making another deposit. Just remember that lenders will always look at the last 2 or 3 months of bank statements in both your checking and saving accounts, money market accounts, or investment accounts to evaluate how much capital you have. Component number 4 is collateral. No matter what you use as collateral or what you want to do with the money you borrow, the definition remains the same. It's your offering to help secure a loan. A loan that uses collateral is called a secured loan. When you buy a home, the home will be the primary collateral for your home loan. In practice, your home will be pledged as collateral for the repayment of the loan. If the loan is taken for a property that is considered new construction, the land will serve as the collateral until the home is finished. To determine the fair money market value of the home you are purchasing, during the purchasing process, your lender will order an appraisal of the property that will compare it to similar homes in the neighborhood. As long as the appraisal matches the purchase price or comes in higher, you're good to go. Refinancing your home, getting a second mortgage, taking out a home equity line, or getting a HELOC are common ways for people to use a home as collateral for home equity financing. But if you cannot repay the financing, you could lose your home and any equity that you've built up. I had a client who needed a creative way to purchase their new home before selling their existing home. They were able to take out a HELOC to access some of their equity to obtain their new loan. When we sold their existing home, they paid off the HELOC. Your home will become one of your largest assets. Here is another warning. When you own your own business, it can get tricky. As a business owner, you are always looking at the best way to manage your income and tax liabilities. Sometimes it is in your best interest to forego some of the potential write-offs for a year or two while you are preparing to make a move. The lender will look at your taxes and base your income qualifications on your income after expenses. I have a client who runs a large company. He makes plenty of money to purchase a home. Yet when he applied for a loan, he was greatly disappointed in the loan amount offered by the lender. The main reason was a $200,000 write-off the previous year. It was a wise decision for his tax liability, but it really hurt him with his ability to get a home mortgage. It's always best to talk to your accountant and lender to coordinate your financial decisions, especially when you are self-employed. There are some special loan types that make it easier for self-employment borrowers. It all depends on your end goal. Tax time is a good time to reflect and to make a few calls to assure that you will be able to achieve your hopes and dreams. You did it! You stayed with me until the end. I told you I would provide a list of the paperwork you will need to start the application process. Here it is. You will need to have 2 years worth of tax returns, 30 days of pay stubs, and 90 days of bank statements. That's it. Easy enough to get the application process started. Now that we have reviewed the 4 C's, which are credit, capacity, capital, and collateral, do you feel more confident in applying for a loan? Do you need help crunching numbers? Do you need an evaluation of value on your current home to determine your capacity? I am happy to help you take the next steps so that you can get the education that you need to take action, even if that action might be to stay put for the time being. Give me a call, send me a text, or shoot me an email so that we can get started. My information is in the description below.